Today what I want to do is take a little time to give you a quick synopsis of how you can get involved in investing in commercial real estate investing. The first thing you need to start thinking about is what type of commercial do I want to focus on? Do I want multifamily? Am I okay with industrial? Am I okay with office, retail, and so forth, right? There's a lot of different pieces that you want to start looking at. You don't just look for commercial in general. The next thing you need to understand is what neighborhood do I feel comfortable in? And in a minute I'll tell you what kind of my basic criteria looks like. You want to know what neighborhood you're going to be in because that will also determine the condition of the properties you're looking for, the income stream that you can expect in those neighborhoods, and so forth. I typically like to be in B to C neighborhoods. I don't like to go to D neighborhoods. I want to be in a weak care neighborhood. I want to be in an area that's still affordable, because when you look at projects that are Class A and really high-end communities, generally they're so overpriced that it's very difficult to negotiate great terms and a good price. Personally, as an investor, and what we do in our fund is we specifically look for off-market deals that are distressed or being mismanaged. We're looking for those properties that have issues with the maintenance on the property, or maybe the manager doesn't do a good job. And our whole objective is to buy it with the intent to renovate, get rid of the tenants that are not performing, put in new management, stabilize that property. The more you focus and specialize in an asset, the more you will benefit long-term. Number one, it'll help you to mitigate risk, because over time, as you begin to do your due diligence, as you begin to learn the asset class and what are the key questions that you ask on a regular basis for that specific asset class, number one, you are safer in the investment decisions that you make. But number two, in the industry, people begin to recognize that you are an expert in that specific asset class. Well, there's a guy I partnered with years ago. He only specialized in office buildings in downtown Orlando. He literally was able, within just a few block radius, over the course of 40 years, he acquired and sold and managed and specialized in just that corridor. And he moved tens of millions of dollars of commercial assets with one asset class in that area. And anytime you talk to any leasing agent, any brokers, or even sellers, everybody knew this guy by name because he was known as the authority figure in that marketplace. You see, when that happens, who do you think people call when it's time to sell? When I first started in commercial real estate, I didn't have the experience, and in fact, I didn't even know what type of asset I wanted to focus on. So what I did is, in essence, I interned for a gentleman who was an expert, and we built a relationship. And over time, I became an investor in addition to somebody who helped them to implement the strategies to make sure the properties were fully leased. So if you want to do this successfully, but you don't really have the time, then you need to start considering who is in your circle for that alliance that can become that mentor or that become that operator, so that when you invest, you know there's an expert behind it that you can watch and progressively grow your portfolio with. How do you actually find a deal? And to be completely honest with you, over the years, what I have learned is that business revolves around relationships. And I will tell you that out of all of the best deals that we've ever acquired, I would say that the number one source of finding these off-market distressed properties came by way of relationships and network. So the faster you build that, the faster you'll get access to great deals that nobody knows about, which means nobody's competing with the prices you get to negotiate. A lot of times, we also invest in technology like CoStar to begin to identify who owns what commercial properties in certain areas. Are the properties vacant? Are they occupied? And we use that as a tool not only to look for motivated sellers, but to work with guys that need financing so they can build and develop their project and take it to the next level. You have to understand that for somebody to take you serious may take various tries. So you have to be consistent and you have to be aggressive, which means you want to send not just one letter, you probably want to have a campaign of 10 or 15 letters. You want to find out who the property manager is and call them on a regular basis. You almost have to build a relationship with these people to ultimately earn the trust for them to want to work with you. And these particular strategies are built so that you can make some very quick calculations to make a determination if the opportunity you're looking at even has merit or potential. So let's get started. The first rule of thumb is what we call the gross rent multiplier. Now, what the gross rent multiplier basically states is that assuming you bought an asset all cash, how many years would it take to pay back your investment over the course based on the gross income that's coming in? And so let's take a look. So the way that you do a calculation is very simple. So what you would do is, if you don't necessarily know what the gross rent multiplier in the area is, and you're looking to find out what the sales of that transaction is trying to calculate, here's the way it works. You take the gross sales price, or what you think the value of the property is, you divide it by the gross annual rents. and that ultimately is going to give you a number. Now, the industry standard is 4 to 7 years is basically what that looks like. Now, obviously, the lower the years, the faster the pay down, which is the better the investment. Let's say you already have an idea, you've studied the market, and you know that the average in that marketplace is a 7, then you can easily take this same formula and run the numbers the other way. And the way it works is you would take the 7, or the gross rent multiplier, by the annual gross rent equals what your offer should be, or the value of that property. And you see in a very quick moment, you can take a look at that calculation and gauge if this is an opportunity that you could actually make an offer on or negotiate, and if it has room and potential for your investment. You have a net operating income, which is known in the industry as an NOI. The way you would do the formula is very straightforward. You would have the gross scheduled income. What does that mean? That means that if that commercial property you're looking at was actually fully leased at 100%, what would that look like? So that represents 100% occupancy. When you have that 100% occupancy, that number becomes your gross scheduled income. From there, you're going to take out vacancy, which depending on the market could be 5%, could be 20%, and depends on that localized market. That number, after you deduct the actual vacancy factor, represents your gross income. Now, once you have your gross income, that's when we begin to break down what the expenses are, and I'll explain why these pieces are so important. So you would have your gross income minus your operating expenses, which are going to be things like property taxes, you're going to have hazard insurance, maintenance on the property, the management fee. In some of these commercial properties, you have a full-time staff that's actually working on the management. In some projects that we've worked on, in fact, we even separated. We have a property manager that's managing the asset, and we have a leasing team that's only responsible for bringing in the actual tenants, and we separate the two for a reason. That's a whole nother video for that. Now, of course, you might have marketing for leasing and so on and so forth. And that ultimately is what we deduct from the gross income, which then leads to the net operating income. Now, on a side note, because we don't have a lot of time to go in a lot of detail, what I want you to understand is that this net operating income helps determine everything. That's how important it is. But understand that when you look at the operating expenses, you'll notice that I did not include the mortgage payment, or what is known in the industry as your debt service. Because technically, when you're analyzing a deal, you're analyzing it as if you were buying it completely cash. So now that you determined exactly how to get to the net operating income, I can show you one of the most popular ways that investors use to analyze a project based on its income stream. And it begins with a formula called cap rate, which is known as the capitalization rate. So basically what this particular formula does, it says that if I were to invest in this project cash, what would be my annualized return on my money based on what it nets every year in income? I call it the IRV formula. The I stands for net operating income. The R stands for the cap rate, or rate of return. And of course, the V represents for the value, or what we call the sales price. Okay? Now, the way that it works is very straightforward. Once you've determined what the net operating income of an asset is, you can very quickly identify what the cap rate is if you know what the sales price is. So let's say the net operating income on a project is $100,000 a year. So if I were to divide that by a 10%, so I divide this by 0.10, which is a 10%, right, of the actual investment return that I want, this will ultimately tell me that the max I can pay for this property is $1 million. And that's as simple as that. What's beautiful though is if I didn't know what the return was, and let's say the scenario existed, I can take the 100,000 divided by the million, and it's going to tell me what the cap rate or return on investment would look like. Now, in another way, you can also invert it differently. Let's say that the salesperson or the person trying to sell the property did not disclose the net operating income. Well, what's really cool about this formula is that you can still put together a measure in your offer that is subject to a specific net income. If you know you want to pay $1 million, or that's what they're asking for, and you know that you want to make at least a 10%, then your offer should be subject to the property being able to produce $100,000 a year in net operating income. You see, this is a very simple formula, and the reason why this is important to understand before you go out there negotiating, making offers, is because you really need to understand how those basic numbers run so that you have a better gauge for what your return would look like. In many cases, if I'm trying to get a 10% cap rate, but the guy's trying to sell it at a 5, there might be such a big difference in our price and negotiation that I can have a conversation and say, look, we're not even close. So within just a couple of minutes, I can discern that we're far off, and I can then have that conversation with the seller and really discern if we can actually negotiate or if it's a waste of my time and I need to move on to another opportunity. So again, guys, here's the cap rate simplified so that you can leverage it to make educated decisions. So in closing, I want you to remember that it is not impossible to invest in commercial real estate, and you really have no excuse. Whether you have the capital right now to go out there and look for opportunities, I hope this video is giving you value to get started. But even if you don't have a lot of capital, it's okay, because you can still use some of the strategies that I talked about in this video to get started.